Hello, friends. Welcome back. And welcome back to one more interesting session upon trying to understand the valuation multiples. Right. So, in this series, we have started the initiative to make you understand the most important valuation multiples being used in the field of financial modeling and valuations, equity research, or core investment banking profiles. So, as promised to you, right, in the previous session, we talked about the price to earning multiple. So again, that was a full-fledged 1 hour long video to make you understand the concept. Now again, I understand the length of the video was too long, but it tried to encapsulate each and every parameter upon the price to earning multiple. Why it is used, when it is not used, advantages of the price to earning multiple, disadvantages of using the price to earning multiple, in which industries can we use the price to earning multiple, right? We also talked about the three most important factors impacting the price to earning multiple, right? So there we talked about the interest rates, we talked about risk, and we talked about growth, correct? We also talked about the practical implication of the price to earning multiple in the industry. We also tried to relate that via certain examples using screener. We also understood a bit of how does a terminal value or a DCF can impact the forward P or the forward price to earning multiple. Correct. So before we try going ahead, right, toward understanding the other valuation multiples, the one thing I want to discuss with everybody here is, right, so before we ideally begin with anything, again, it's a humble request to everybody to subscribe the channel and press the bell icon, which will again motivate me to continue coming up with more such interesting insights and more such interesting videos upon the field of finance and equity research to make you understand things practically. Right? The videos might be long, but again, they shall be full of valuable content. Right? So again, I'll just start sharing my screen, and here is the MS Word. So as we understood in the previous session, we talked about the price to earning multiple, and now we understand ki what exactly is the price to earning multiple and why is the price to earning multiple important or not so important, right? For all of those who've still not watched the previous session upon the price to earning multiple, again, I would request go back and understand that session and then watch this video. So before we go ahead in trying to understand the second multiple, let's try to understand much more upon, I would say, a concept which is linked to the price to earning multiple. And that is something which is called as earnings yield. Earnings yield. Now, again, this concept is again very important, is being used in the field of financial modeling and valuation. It's also being used by many analysts and many fund manager or stock market experts or the enthusiasts to gauge or to get to know that which market will perform well, whether equity market will do well or the fixed income market will do well in terms of bonds or debentures or money market instruments. So again, earning yield is again a very important metric from the point of view of companies' valuations also, right? I've been trying to suggest this via different videos, via different posts on LinkedIn, that the most fundamental crux for any company is the earnings and cash flows. Cash flows being the priority, and secondly being the earnings, that's the bottom line, the profit after tax. Correct? So basically, what happens, the companies are being judged based upon their earnings. If the earnings are good, and as I told you in the price to earning multiple session as well, that even in the practical world, in the practical stock market scenarios, we can even accept or buy a company having a higher price to earning multiple only if the growth is supportive. And the growth of what? The earnings growth. Even if the earning growth is supportive, a higher price to earning multiple is justified, right? But if the price to earning multiple is high and the earning growth is not there, in that case, even a higher price to earning multiple is not justified. In that case, we can categorize the stock as being an overvalued stock and give a sell recommendation upon that particular company. And the vice versa is also true for an undervalued stock, correct? Or a cheap stock in the market. Now, how to calculate this earnings yield? Again, no specific deep dive formula. So as the name suggests, earnings yield, it's basically telling you that how much the earnings of the company are making for you. What's the yield of the earnings of that company? So for example, if we talk about the price to earning multiple, you just do an inverse of the price to earning multiple. So the current market price of the company in the numerator divided by the earnings per share, right? The trailing 12 month earnings per share is the price to earning multiple of the company. The inverse of that multiple is the earnings yield. The earnings yield cannot be exactly categorized as multiple because companies are not valued based upon the earnings yield. The companies are valued based upon the price to earning multiple only, right? But earning yield is a very important formula. It's a very important concept in the field of financial modeling and valuation, and also being used to judge the overvaluation of the equity market or the undervaluation of the equity market and the future outlook of the equity market versus the fixed income market. I'll tell you how. So simply, the current market price of the company divided by the earnings per share is the price to earning multiple. The current market price divided by the TTM earnings, the trailing 12-month earnings, right? So that's the price to earning multiple. If you do the inverse of that multiple, that is, you take a trailing 12-month EPS in the numerator. So now instead of the current market price, you have the trailing 12-month EPS in the numerator and you divide this by the current market price. Just you do the inverse of the formula of the price to earning multiple. And once you do that, you get something called as the earnings yield. Or simply, if you already have a price to earning multiple with you, which will be there with you in almost 99.999% of the cases, multiple softwares, right, or websites are there to give you the price to earning multiple. Money control है, Screener है, Bloomberg है, बहुत sources है. Just do so. For example, if the price to earning multiple is 10, the earning yield is 1 by 10, right? 0.10. So just do an inverse of the price to earning multiple और कुछ भी नहीं करना, ये उतना आसान है. Now, if earning yield in isolation, right, is a misleading number, or I would say not misleading, but useless number. Correct? You always need to compare the earning yield with something called as a bond yield. And we all know ki what is bond yield. How much the bonds are giving us by holding the bonds on a long-term basis. Right? Though I understand it's not a session upon the fixed income instruments, but just to tell you as a generalized approach that whenever we talk about a fixed income yield, now fixed income are those instruments that pay you back the principal on maturity along with they guarantee you certain kind of interest payment on a monthly basis. Correct? So as in case of equity, there are two types of returns we get from holding an equity share. One is the capital appreciation. That is, if we buy a stock, like for example, like supposedly 100 rupees, right? And the price of that stock rises from 100 rupees to 150 rupees. So 150 minus 100, 50 rupees is my capital gain. And the second is a dividend or expected dividend from that particular stock. So two sources of income or two sources of money making from an equity share. One is the capital appreciation and the second one is dividend. But if we talk about the fixed income, from fixed income, again, you get two things. One is the mark to market gain and losses. Mark to market, MTM, right? So we tend to call that as MTM, mark to market gains and losses. And the second is the interest that you make, the interest rate that you make. So bond might be issued at a face value of 100 rupees. The market price might be something different based upon the demand and supply. Right? If the demand is high, the price might be much more than 100. If the supply is high, people are selling that fixed income instrument, be it a bond or a debenture. In that case, the current market value might be lower than the face value. And also the interest rates, right? So two set of income you make by holding a bond till maturity. That is, you get back the face value of the bond based upon the mark to market gain and loss because at maturity the price has to converge right towards the face value, correct? And hence you do not incur any kind of price risk because at the maturity the bond will not be overvalued or undervalued. You will get the face value on maturity, right? And the secondly is the interest. So two set of components you tend to make from a fixed income instrument. So yield is nothing but you purchase a bond and you hold the bond till maturity, and whatever money you are making in terms of mark to market gains or losses, like which shall be equal to the face value only, plus the interest rates. The combination of these two income streams is the yield on bond, yield till maturity. We tend to call it YTM, yield till maturity, and that is nothing but the bond yield. Bond yield is same as YTM. Okay, bond yield is exactly same as yield till maturity or expected yield till maturity. right? Now, the earning yield is always compared with bond yield. Earning yield is always compared with bond yield. So before we go to bond yield, let's go to where? Let's go to screener. Let me open screener. Let me open one fresh tab and give me a second. Not this. Just a second. So here we go. And here I open maybe if I want to know. Yeah, here it is. I just took into account Tata Motors, right? So for example, the P of Tata Motors, the stock P as per screener is 19. So what is the earning yield of this stock? The earning yield of this stock is 1 by 19. Correct? The earning yield of this stock is 1 by 19. And what's 1 by 19? 1 divided by 19, it is 0.05. 1 divided by 19, it is 0.05. That is 5%. Exact is 0.052. 5.2% you can say. So 5.2% is the earning yield of that stock. Again, similarly, as we did with the price to earning multiple, the earning yield can be compared historically. कि पास में किसी भी स्टॉक की अर्निंग यील्ड कितनी रही है, मीडियन अर्निंग यील्ड कितनी रही है, एवरेज अर्निंग यील्ड कितनी रही है. करेक्ट. जैसे प्राइस टू अर्निंग मल्टीपल में आई टोल्ड यू लाइक स्पेसिफिकली फॉर द इंडियन मार्केट्स और इमर्जिंग मार्केट्स व्हिच आर वोलेटाइल लाइक व्हिच आर ग्रोइंग, इन दैट केस द मीडियन प्राइस टू अर्निंग मल्टीपल, right, it needs to be taken into account. Correct. And not the average price to earning multiple. Why? Because if we talk about markets like India, not all the sectors have similar price to earning multiples, right? So different sectors have different price to earning multiples. The range or the range difference of the price to earning multiples for different sectors is very different, right? So for example, if we talk about a consumer sector, you talk about a retail sector, they trade at multiples somewhere closer to 40 times to 80 times, right? If you talk about an IT sector or you talk about an healthcare sector, they might trade somewhere between 20 times to 30 times. For some industries, price to earning multiple might not even be used, right? So different sectors tend to have different quantum of the price to earning multiple, right? So hence, since different sectors have different quantum of the price to earning multiples and even the averages also changed, right? Every year, the averages also change, correct? So even the multiples also tend to change, right? What we see as of now, so for example, if Nifty 50 is currently trading at a 20 times price to earning multiple. So before this Iran US conflict, it was trading somewhere between like 22 times to 23 times trailing price to earning multiple. And everyone used to say that 22 times is surely very high. Our average 10-year multiple has been closer to 19.5 or 20 times price to earning multiple. The 10-year average multiple, right? And similarly for the Nifty 150 mid cap index. The Nifty 150 mid cap index is trading somewhere around 33 times price to earning multiple, right? But the average is somewhere closer to how much? The average is somewhere closer to like 24 times price to earning multiple. And the small cap again stands in the similar trajectory, right? The average might differ from the current multiple. So that doesn't mean that there would be a mean reversion to the average 10-year multiple. What we believe as of now that 22 times might be expensive for Nifty 50 large cap, or maybe 33 times might be expensive for a Nifty 150 mid cap index, or maybe 26 times or 27 times price to earning multiple on a trailing basis might be expensive for a small cap index, right? After 10 years or 15 years, or maybe I would say less than that, these numbers might become the average 10-year multiple. Every 10 year, every 7 to 10 years, the average price to earning multiple of the index tends to change, right? The mean shifts towards the right. We talk about something as a kind of historical distribution, right? हमेशा we talk about something as a kind of historical distribution के बारे में बात करते हैं, right? So if I just go to the whiteboard once again, right? So for all of those who are the students of statistics, so usually we have an historical distribution like this, right? And all these values are equidistant towards the mean. मतलब यहाँ का भी distance same रहता है and यहाँ का भी distance same रहता है, and this line is the mean, correct? So usually like what has been assumed in the market for past many years, that all the multiples at an index level or maybe at the company level later will converge to the mean, right? But now what we have seen historically, especially after 2014, right, or 15, this average has started to shift towards right, right? In 2014, when the Modi government got elected, there was a slight shift in the average. The average price to earning multiple for Nifty 50 became somewhere closer to 18.5 from 17.5 or like 18, right? In 2021, it was mandated by different authorities that you need to have a consolidated price to earning multiple and not a standalone price to earning multiple. What do I mean by that? Different businesses, like for example, a company A might have different businesses, and that businesses might be listed as separate companies by separate names but having the name of the parent company. So for example, Tata Sons is the parent company, but Tata Motors being listed separately, Tata Elxsi being listed separately, correct? Tata Power being listed separately. So instead of having, though that thing is still prevalent, each company will have like one price to earning multiple, but the parent company at a consolidated level will be having one price to earning multiple at the consolidated level. It is also applicable for those businesses where the multiple set of businesses has not been listed, or just like one set of business has been listed. So now the companies are mandated to report a consolidated price to earning multiple. So again, around 2021 or like 2022, this mean shifted towards the right, and the average multiple became 19.5 to 20. So every 5 years, every 7 years, or maybe max to max every 10 years, if this curve is like this, right, this curve might shift like this because average अगर आपका यहाँ पे था बीच में, this average might shift rightwards, and hence this curve will also get skewed rightwards. आपका curve भी इस तरफ shift हो जाएगा. So every 7 years to 10 years, as market grows, as market prospers, as earnings come into place, the multiples get expanded in a booming economy, growing emerging economy. If the average 10-year multiple has been 19.5 to 20 times as of now for Nifty 50, and the same goes for the other indices as well, it will not remain the same. It might become 25 times, 22 times 5 years later. What seems expensive as of now might become the average price to earning multiple 5 years from 5 years afterwards or 10 years afterwards. Correct. So if I talk about specifically, if I just go back to internet and if I want to know एक निफ्टी 50 का लाइक हम कंपैरिजन कर लेते हैं, करेक्ट? So Nifty 50 अगर हम देखें the multiple has come down. The major reason is the Iran US war, right? So 20.8 is the price to earning multiple. So closer of if we see the 20 is the price to earning multiple, right? अगर मान के चले मोटा मोटा या मान के चल लेते हैं कि 21 times is the price to earning multiple. So what's the earning yield? So what's the earning yield? Earning yield is 1 by 21, that is 0.047. 0.047 uh, 4.7%. So broadly 5%. Correct? 1 by 21 will give you 4.78%. That is broadly 5%. So 5% is the earning yield. Correct? Is the earning yield. It means Nifty is giving you a decent earning yield of 5%. Correct? Assumingly, and this number should be as high as possible. If this number is low, if this number is low, it means equities are overvalued. If this number is low, it means equities are overvalued. Correct? So, assumingly, not assumingly, if we talk about September 2024, right, when the earnings peaked, the Nifty 50 earnings peaked, and the same happened with the other indices as well. At that point of time, the Nifty 50 P was 25. So let's do a 1 by 25. It is 0.04. 4%. 4%. Correct? So here we can see the earning yield is rising. At 4%, we peaked out. At a 4% earnings yield, we peaked out. But now the earning yield has started to rise. It has become 5% now. 4.8% or 5% now. And we want this earning yield to rise. At that particular point of time in September 2024, This number became a smaller number. And that showed the market has entered into a bubblish territory or a bubble territory because the earning yield had come down. But now, if we see from 4% to 5%, the earning yield has risen. And in terms of earning yield, even a 0.5% increase is a very good number, a big number, and it takes time to come up. आप ऐसे मत सोचो कि 1% है, राइट, तो कभी बढ़ जाएगा या फिर कभी कम हो जाएगा. इन केस ऑफ अर्निंग यील्ड, इट टेक्स टाइम फॉर अ +1 और अ -1 हिस्टोरिकली. Correct? So you always need to compare the earning yield with the bond yield. So for example, अगर मुझे bond yield जाननी है, ठीक है, कि what is the current bond yield, तो राइट, तो मैं कैसे जानूंगा? I'll go to a fresh tab. I'll type in here as India 10-year bond yield, and we always compare this with 10-year bond yield. And for multi-asset portfolios, as a multi-asset perspective, this difference of earning yield and bond yield tells you that whether to invest into equity market or fixed income market. Again, I'm not saying the analysis or the interpretation might always be 100% correct. It might go haywire, it might go opposite. But many analysts, I would say all the analysts in the market or the fund managers or the investment specialist people tend to look at this difference. So currently we see 6.7. ठीक है, so 6.7 is a 10-year bond yield. So what's the difference between the earning yield and bond yield? So earning yield हमने देखी थी कि 5% था. ठीक है, 5% for Nifty 50. Correct? And the bond yield, this is your bond yield, your YTM, is 6.7. We do 5 minus 6.7. So minus 1.7. See, on a daily basis, on weekly basis, the multiples might change 0.5, 0.6 की वैल्यू से. इवन दिस यील्ड माइट ऑल्सो चेंज. 6.7 का हो सकता है 6.6 हो जाए, 6.8 हो जाए, देन 6.6 हो जाए, देन 6.55 हो जाए. ठीक है, डिपेंडिंग अपॉन द मैक्रो एनवायरनमेंट एंड द बॉन्ड इशूएंस एंड सेलिंग. ठीक है, और बेस्ड अपॉन डिफरेंट मार्केट कंडीशंस. So this number might change, but broadly we can say the difference is 1.5%. Broadly we can say 5% as a Nifty yield and 6.5% if you take for bond yield. Right, so 1.5% has been the difference. Correct? So 1 point minus 1.5, not 1.5, minus 1.5, because the earning yield being a smaller number 5% and the bond yield being a bigger number 6.5%. So minus 1.5 is the difference. Now you might say कि दिस नंबर शुड बी पॉजिटिव. करेक्ट? सर आप तो बोल रहे हो कि अर्निंग yield शुड बी एज हाई एज पॉसिबल. Correct? But I did not say कि bond yield should be as low as possible. I never said that. I just said earning yield should be as high as possible. अब now you will say, sir, जब difference ही negative है, then why should go for equities? जब difference ही negative है, then why should go for equities? This difference of minus 1.5% is still indicating that equity markets are overvalued. Correct? But one thing that we have seen is 5 से 4 पर आ गया है. 5 से 4 पर आ गया है earnings yield. Now, here I'll show you one database. ठीक है, कि based upon your understanding, ठीक है, my audience believes कि equity markets are overly valued because this spread between the earning yield and the bond yield is negative. Let me show you one PPT. Let me show you one PPT. Now again, this is not created by me, right? इट्स अ पीपीटी विच इज पब्लिश बाय यूटीआई. जान का डेटा है, इतना पुराना नहीं है, हम अभी मार्च में हैं. बट टू अंडरस्टैंड द थिंग्स, आप मल्टीपल्स इग्नोर कर सकते हो, आप मार्केट का रिटर्न इग्नोर कर सकते हो इस पीपीटी से, जो मैं आपको दिखा भी नहीं रहा हूँ. ठीक है, बिकॉज 2 महीने पहले का रिटर्न इज फारली डिफरेंट. द वैल्यूएशंस ऑन प्राइस टू अर्निंग, प्राइस टू बुक इज ऑल्सो वेरी डिफरेंट. ठीक है, अब मैं आपको एक चीज़ दिखाऊँ. एंड जो भी आप यहाँ पे फंड्स देख रहे हो, दैट डजेंट मीन कि इट्स अ काइंड ऑफ एनी स्टॉक रिकमेंडेशन और अ फंड रिकमेंडेशन. इट्स योर कॉल कि आपको कौन से फंड में कितना पैसा डालना है. Just see this graph. Just see this graph. That's the difference between Nifty 50 yield that we have seen as of now, correct, and a 10-year GSEC yield, Indian bond yield. Long term difference has been minus 0.94. Currently, we stand at minus 1.5, and that we calculated. The long term average difference has been minus 0.5. So here we can see on an average basis, the yield has never been positive. The difference in your earning yield and bond yield. We technically call this as earning yield bond yield spread. The spread between earning yield and bond yield. On an average basis, it has never been positive. The average still has been minus 0.94. Correct? And technically, this was even lower. This was even lower in December 22, 24. यहाँ थोड़ा बढ़ गया था at the peak. Right? फिर नीचे गिरा. But now we have again started to rise. Right? So in this phase, if you saw much of your September 24 से लेकर till your December 25, like many of the people who had exposure towards the multi-asset portfolios into fixed income, they made money. At that particular point of time, fixed income gave you more yield versus earnings yield. And many of the fixed income instruments, in conjunction with equities, gave made more money for investors. But now if we see, it has bottomed out. The earning yield has bottomed out. Now it has started to rise. It peaked in December 19. सिर्फ एक ही बार ऐसा हुआ है कि आपकी ब्रॉडली की पॉजिटिव ट्रैजेक्टरी में चला गया हो in 1920. Correct? When your, I would say, that is that time when your yields were brought down, right? The repo rate was cut almost close to zero. Correct? At that particular point of time, and the company started to report the profitability, तो उनकी earning yield बहुत ज़्यादा high हो गई थी. Correct? And the bond yield was very low because of the interest rates being cut down in the market, right, to stimulate the growth after COVID. Correct? तो average has been minus 0.94. Bottom out हो गया है. So doesn't this whole chart holistically indicate it's time for equities? Absolutely yes. Correct? So that is the interpretation. Sometimes what we do generally, sometimes people also take, I would say, a ratio, correct, of the earning yield and bond yield. ठीक है? तो if we talk about कि earning yield हमारी कितनी थी 5%, bond yield कितनी है 6.5. If I do a 5 by 6.5, it gives me 0.7. 5 by 6.5 में करूं, it gives me a 0.7. 5% is the earning yield and 6.5 has been the bond yield. So 0.7. And again, 0.7 has been the average. The 10-year, 15-year average has been 0.7 as a ratio also. Correct? So what I'm saying is, just a second. Hmm, yeah. Yeah. So this is the graph I was talking about. On an average, जब 0.94 ही रहा है, right? So I guess like this graph like wasn't visible earlier. Minus 0.94 ही रहा है, correct? And अब minus 1.5 पे है, and we have bottomed out here, right? This equity, this number has starting to rise. This difference has started to rise now. So isn't it time for equities? We only peaked here, right, at the COVID time. But the company started to bounce back जब COVID के end phases में थे. The repo rates were cut almost close to like 1%, 2%. The interest rates were brought down. And the company started to report the profitability, a revenge back of the business, right? The business started to come back, the productivity expanded, the growth was there. तो यहाँ पे like it was positive. Again, an extraordinary outlier scenario in this case, correct? But the average has been minus 0.94. And we have bottomed out here, we have bottomed out here, we have bottomed out here, we peaked out here, and then we bottomed out. So here we bottomed out again, and then we're starting to have a new trajectory, which shows it's time for equities, basis upon the earning yield and bond yield spread. Now, sometimes people tend to take a ratio. Sometimes people tend to take a ratio of the earning yield and bond yield. So अपना earning yield was 5%, our bond yield was 6.5. We took the ratio, we got 0.7. Again, this 0.7 is a 10-year average. It means we are at average in terms of the ratio also. ठीक है, अगर ये 0.8 हो जाए या 0.9 हो जाए तो इसका मतलब क्या हो जाए होगा? तो denominator has become a smaller number, and maybe the earning yield has grown up, has become a larger number. So that is something which is good. But if this number becomes 0.6 or 0.5, it means the earning yield has come down and the bond yield has expanded, which might again indicate it's time to go back towards the fixed income. Sometimes, even since we took in this case earning yield in numerator and bond yield in your denominator, sometimes bond yield is taken in numerator and the earning yield is taken in denominator. कभी कभार हम बॉन्ड यील्ड को न्यूमरेटर में लेते हैं एंड अर्निंग यील्ड को डिनोमिनेटर में लेते हैं। तो वहां पे हमारे पास एक नंबर आता है दैट इज 1.3। 1.3। So whenever this number is also closer to 1.27, 1.27, 1.3, it means we are at the average. We are at the average, correct? And if this number starts to come down from 1.29, 1.27, 1.255, it means earning yield is rising. Your denominator is becoming a higher number vis-a-vis the numerator, which is the bond yield, and it shows a time to go for equities. Earlier, this number was 1.37, 1.4, 6 months back, 8 months back, which indicated equities are overvalued. The earning yield or denominator is becoming a smaller number, and the bond yield was still high. Despite the 125 basis cut in the repo rate, the yields still they hover between 6.5 to 6.7. Correct. So that is the logic. So this number is the average number 1.27 like 1.3. It's going towards a downward trajectory now. And even this 0.7 ka number, which is the average now. And the difference, that is your earning yield minus bond yield, has bottomed out at one at minus 1.5. Now we're coming towards a less negative trajectory, minus 1.4, minus 1.3, and so on. Correct? So that is the understanding of the earning yield and the bond yield and equity earning bond yield spread, or the difference between, or the ratio of the earning yield by bond yield. How to interpret that, right? We understood that the ratio has been historically zero point 0.7. Earning yield by bond yield, I'll repeat my point from starting. If we talk about currently, the difference, the earning yield and the bond yield, the difference is minus 1.5%. It has bottomed out. It's coming back again to minus 1.4 to minus 1.3. The 10-year average in difference has been minus 0.94. It has never been sheerly high barring the COVID period or after the COVID period, where the interest rates were cut down sheerly low to closer to 1%, 2%, and the corporate profit started to bounce back. At that point, this difference became positive. But the average 10-year has always been in negative minus 0.94, and we have bottomed out at minus 1.50. It's again rising up. Secondly, if we talk about the ratio, earnings yield divided by bond yield, average 10-year ratio has been 0.7, and that shows we are towards a good trajectory. From this number should rise to 0.71 to 0.75. Secondly, if we take the inverse of this ratio again, a bond yield को ऊपर ले लो and earnings yield को नीचे ले लो. This ratio has been closer to 1.27, 1.3 historically. Now, if this becomes, right, if this ratio, ये वाला 1.3, 1.5, if this ratio becomes smaller, 1.2, 1.1, ठीक है, 1.25, 1.24, correct, it means the earning yield is rising, and that is something that we want. So that's the interpretation of the earnings yield and the bond yield from a practical context, and basis upon that, an asset manager or a fund manager tends to understand that whether equity is overvalued or undervalued versus a fixed income market being overvalued or undervalued, and whether to invest into fixed income or equities. And it also helps the fund manager to take, I would say, a high bet towards equities or a lower bet towards equities. Correct? Being overweight upon equities, being underweight upon bonds. When this spread has bottomed out to minus 1.5. But when it's still going at the bottom and the bonds are being favored, a fund manager might be overweight upon the fixed income securities and underweight on equities in the portfolio. This is how, based upon which the decision or the allocation between equity and the fixed income takes place in a fixed income portfolio. That's one of the most important factors. There can be multiple other factors as well. Thank you so much. If you liked the video, do subscribe and press the bell icon. Thank you.